You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Thanks for tuning into MSC. I am your host, Bill Powers, and chatting with me today is self-directed small cap investor Mark Zaret. I've had many requests both in the YouTube comments and people sending messages through the website, MiningStockEducation.com, and emailing me directly, asking for a visit with Mark Zaret. Mark, you don't show your face very often on YouTube, so I appreciate you coming back on. You're also a strategist with a fund in Toronto, advising them on opportunities in the small caps, so welcome back onto the show.
Thanks, Bill. Good to be here.
And I'd like to start off with what you recommended or told my listeners 25 months ago, over 2 years ago on the show, about a stock pick, Tenaz Energy. You recommended it, I remember, at $1.40 per share. It's over $13 per share right now. So we're looking at like a 9-bagger in 25 months. That's an example of what worked out. What's your commentary on that pick, and maybe review your rationale going into that pick as well?
Okay, Bill. It's interesting because here we are 2 years later. And I guess my first thought is, I wonder how many people kind of ride through an experience like that. And it, there's been many groups that I've been involved with over the years, and in terms of sharing ideas and so on. And a lot of them, they don't last. They don't stick. They don't last because I just feel like a lot of people are looking for an instant get rich quick idea. And I've often thought that stock promotions can happen overnight, but building real companies can take years. And my primary focus has been to stick with people that I believe are building real companies, which is a real, few and far between. So I think the fact that we are 2 years later demonstrates the fact that if you really want to make money in this sector, you have to have long-term eyes when you're getting into these things, and you really have to know who you're dealing with. And even with having good criteria for picking those players that you want to support, you're still going to have mistakes now and then. But the rationale, to answer directly your question, was very simple. There was a gentleman by the name of Tony Marino who had built, not from scratch, but he had been the CEO of a company called Tenaz Energy. And under his guidance, he was the CEO. Under his guidance, I think the company grew in market cap by about $4 billion over a period of, I can't remember now, but I think about 5 years. And that's a pretty extraordinary track record right there. And then he went on to begin to do the same thing at Vermilion Energy, which is another multi-billion-dollar company. And Vermilion, unfortunately, he was the CEO when oil went minus $35 a barrel, which we forget, but it actually did. You had to pay to get rid of your contracts in March of 2020 when COVID was pretty much rampant, taking over everybody's investment thesis. So with oil going negative, all oil companies got into pretty serious trouble. And I always believed that Tony was the fall guy for Vermilion. So while he was in the process of, I think, building a lot of value there, again, it kind of got sidetracked. And I believe that he became the fall guy. And so here he was striking out. I was about to say on his own, but this is the really wonderful part about Tenaz, is that he was really bringing very much of the team that he built Baytex and worked with at Vermilion into this, in essence, an oil and gas shell virtually, and with a promise of building, at least a 50 million BOE a day oil and gas, intermediate sized company. And he's proceeded to do exactly that. What's really remarkable is he's done 2 acquisitions, and there are less shares outstanding today than when we talked about it. So there's a man who knows how to do a deal, and there's every reason to believe that he's going to do more and continue to build the company.
So it was a bet on management, essentially.
Well, exactly. Yeah, it was totally a bet on management, and that's tends to be what I focus on. So, I think if there's a message here, it's really, once again, to repeat that it's all about management. It's all about understanding who is involved here. What's their track record? I mean, thanks to the wonderful toys that we have today, you can spend some relatively short period of time on the internet and really figure out who these people are. And then second to that is you can often go meet them. I mean, they do road shows, they present fairly regularly. Tony himself has done YouTube interviews with other people. I've actually managed to speak to him a few times, by cell phone, available. So, anyway, there's avenues to really get to know and understand who it is you're investing with.
So even though it's a bet on people, what you're articulating is that you had a more informed or nuanced take on Tony in what happened at his last company. Because often what I see is investors, when it goes wrong, there's always the fall guy, and perhaps many fall men at a particular company. Investors get angry. But even though that happened, you didn't write Tony off. You had a more nuanced or informed perspective. Would that be an accurate statement?
I mean, you could say that, but again,
And I don't know Tony.
finding out that he was the CEO of Baytex during a tremendous growth period was not a secret either. One just had to really turn a couple of pages to really build a better, clearer picture of who this man was. And
But you viewed him through the lens of what he had done and could do, versus some would just view him through the lens of the past unsuccessful venture.
yeah, I suppose you could say that. Yeah. I mean, he still was. I mean, Vermilion was not it didn't. I don't believe it suffered more than any other oil and gas company at the time. Right. And in fact, the fact that it survived and has at least partially recovered, I think, is testimony to the fact that it was a company with good assets, because there were more than one bankruptcy through that whole period.
Yep. And you mentioned there's less shares outstanding now than there was when you invested.
Right. Because what they did is they've done 2 deals, and both were done without issuing any equity at all. And then as well as that, they've been buying back stock. So that's why the share count has actually gone down.
And have you held through the whole 9-bagger?
Yes, of course. I shouldn't say of course, but yes. Well, I mean, and we touched on this previously as well. So many people will sell a winner just because, but they'll hold on desperately to those losers. And I really try and do it the other way around.
Mm-hmm. So you mentioned a couple of years ago, 3 stocks. Another one was Grounded Lithium. That one kind of went the other direction. Have you held on to that one, or are you still holding on to that one?
Yes, still own. The thesis was okay at the time. I wasn't happy with every move the company made. They made some tactical error as far as I'm concerned. But once again, we have a scenario where the price of lithium carbonate is down, I think, around 80 to 85% since in this 2-year period. So once again, every lithium stock basically got destroyed, and they went along with it. So to be frank, I mean, I've been buying. We've been buying stock, through this whole downturn. I suppose that breaks another rule, or at least something that we're often told, is that averaging down is not the right thing to do. And I think if you're a trader, of course, averaging down is poison. But if you're an investor in small caps and you understand cycles, and your initial thesis is not broken, then it's not necessarily a bad thing. I think I might argue the opposite. So we've brought our average cost down very, very significantly by being in the market now when it's trading at just, call it a nickel, I don't know, 5, 6 cents, something like that. And there's still a reasonably good story to be told there, which I can, if you want, your call. I mean, I can go into some detail on it.
Sure. What's your current take on the company?
Well, they have a partner in Denison Uranium. Denison is no small company. They've committed, I think it was about $15 million to the project of direct lithium extraction, DLE. Denison, so they just recently announced, I think they were going into the phase 2 of their multi-phased agreement. And the interesting thing about it is that Denison is, at the end of phase 2, Denison is only $1 million short of bumping their ownership of the project from, I think it's something like, give or take 20% to 50%. So to own another, call it 30% of the project, 25-30% of the project for another $1 million, it's a no-brainer. They're going to put in the $1 million. That's going to get them to phase 3. And through this, they're going through the pre-feasibility stage on their project. And there's been nothing material that says that direct lithium is not going to work. And if that was the original thesis and it was a bet on DLE, it's not a broken idea. It's just a broken stock. And so therein might lie at least an opportunity to average down for somebody who's already owns it, and maybe to take a fresh look at it. Because at 5 cents, I think the market cap is about $4 million. Well, I'll remind you that their very first preliminary economic assessment said it had a net present day value of $1 billion. So, okay, obviously prices, costs are going to go up, all kinds of things. There's lots of moving parts, and there's still stuff to prove up here. But for them, at the end of their agreement with Denison, to still own 25% and have a $4 million market cap, my personal idea on this whole thing is that if Denison proves up what they want to prove through the continued advancement, they'll be willing to pay more than $4 million to capture the last 25% of the project. So the upside could be 5, 6, 8 times your money at current levels.
Mark, this kind of brings in the macro picture. Obviously, the market cap and share price was affected by the price of lithium. So do you need the price of lithium to perform, do you think, to see the share price re-rate higher?
Yeah, more than likely. Yeah.
And you're willing to stick around. So do you come up with a macro thesis on the price of lithium then as part of your investment?
If I was to say I haven't spent 5 minutes on that, I think that might be accurate. My bigger thought on it is that these things are cyclical. All these prices, these metal prices are cyclical. Commodity prices. I know you've had Rick Rule on many times, and I know one of Rick's comments is always, the cure to higher prices and the cure to lower prices, et cetera, et cetera. And there's a lot of truth in that. So, it'd be hard to argue that there won't be a positive cycle for lithium, just on a intuitive kind of, with the eventual electrification, I'm not so sure about the speed at which this will all happen. I think ultimately it will happen. But I do think at some point in the future, lithium will have another day in the sun. So, yeah. No, everybody's different, If you need a tax law, sometimes you do what you need to do to offset another gain. And everybody's got their own portfolio, and their own, obviously, risk tolerance and so many other factors that might make a personal decision, might make an investor do a completely opposite move, right? So
do you pay attention to what's hot? Like AI stocks were hot, of recent. They've come off a little, but do you pay attention to the hot sectors and then maybe try to find good small cap opportunities within it? Or are you just totally oblivious to that? You just look at each opportunity as it's presented to you?
I've kind of learned over the years to be oblivious, because I just find chasing them typically doesn't work out all that well. So, there's a lot of hot money that can get involved, and you see a lot of pyramids in hot sectors. In other words, stock prices that go like this. I tend to really be more of a bottom up, find the right people to back. And, included in that, and I can't remember if we touched on this, Bill, but included not in that, it is sometimes investing in shells and letting those people be your brain, in a sense. In other words, if you trust them and they know more than you, and they own a company, say, with cash and no business, if they elect to go into AI, now you're in the AI business, whether you liked it or not. But I think I might have told the story of the fact that I owned, I think, 3 or 4 shells that all got into uranium in the early 2000s. What did I know about uranium? I can tell you nothing. But suddenly I owned 3 uranium stocks, and 2 of them were taken out, for their deposits. So no, I don't go chasing AI or anything else, frankly. Generally looking for the right people to back with more or less sector agnostic.
Mm-hmm. And now, going back to Tenaz Energy, when that was reorganized and the new management team came in, didn't they seed that with about that reorganization with like $5 million or something? So then they had skin in the game as part of the move forward. There are some people that have shells that don't put skin in the game. So you're looking for people that put skin in the game, even at the shell level, right?
Yeah, absolutely. Yeah. Or if I own a shell and then I'll examine the deal of, what they decide to do. If I don't like the look of it, I don't have to stick around. But yeah, you're correct. That was a really important piece of it. And by the way, when I say less shares today than then, I'm taking it from the moment that Tony and crew stepped in, bought 5 million. And what was the share count, post like that day. So that, in other words, that was the day that they really took over the vehicle. And by the way, they owned, or they had another equal amount in options at the same price. So effectively, they weren't putting in 10 million that day, but effectively, they had the right to put in 10 million, which is a sizable number. And of course, they're well in the money now, but they well deserve it. And you know what? So many of these kind of situations, you'll find if you dig deep enough in filings, those 2-cent deals, those 3-cent deals, those nickel deals, there are none here. Their entry was at $1.80, and there was no cheap paper.
Mm-hmm. What was your biggest mistake over the last year, or a lesson learned, if you're willing to share?
Lesson learned over the last year. I mean, I can't say nothing, so I've got to think of something. Maybe we could let me ruminate on that for a minute.
Sure.
I'm sure there's things.
Yeah, we've been talking about your success, right?
Yeah, there's no question. You know what? Let's put grounded lithium up on the board again, because I actually think it might be the biggest loser. But
you funded it on the way down. You shared too, right? Or you've bought more shares on the way down.
I'm still hanging in and buying and have bought more.
Mm-hmm.
But I think on an examination of the portfolio, that might be the biggest loss. So there you go, Bill. I've shared the best and the worst with you.
Yep.
How about that?
Yep. And like moving forward, are you seeing any opportunities in the resource sector, or are the majority of your new investments, are they outside the resource sector right now?
There's some of both. We've been fortunate through a very bad real estate. We've been fortunate through a very bad mining market to have diversified into some other areas that have done quite well. So I think they're somewhat off limits to MiningStockEducation.com. I don't know if you want to stick to mining, but I mean, the short answer is yes. We have, we are somewhat diversified. I think it's about 60-40 mining, other mining, call it resource. It's about 60 resource and 40 non.
Any new resource stocks you'd want to share? You did really well with Tenaz, so.
Well, you know what? I guess there's a couple of things I would say that come to mind. One is, let's talk about the third stock that we talked about 2 years ago, and that was Fortune Bay. And as it turns out, the price today is exactly what it was 2 years ago. So that's the kind of mid-ground, right? Flat line. But it's still a very, very interesting situation to me. They still own 2 million ounce deposits that are both amenable to open pit, one in Saskatchewan, one in Mexico, as well as a phenomenal uranium exploration team that have assembled 6 different projects, all in the Athabasca Basin region in Saskatchewan. And once again, the market cap is, I think, about $12 million. So something will ultimately happen there. These deposits are too good. Gold has gone up, substantially in this 2-year period since we talked about those 3 names. And I think it's just only a matter of time before somebody steps forward with Fortune Bay and puts in some sort of offer to either do a joint venture or outright buy it or outright buy the company or something. But I would still argue at 26 cents that it's a very asymmetric bet on a junior gold explorer with great management, great structure, great share structure. So I think that's still worth at least having a look at. And I think perhaps it's also worth mentioning another junior gold that I don't think we've ever talked about, and I'm not sure has been mentioned on your show or not, but you're probably somewhat familiar with Orion Gold. The symbol is AU. I know you've had Dave Lotan on, who is the CEO. It's a very intriguing situation. I mean, I remain completely baffled by the current share price. And I think the most important thing to know there is that their neighbor, Rupert Resources, is sitting on a really good gold deposit. But if you ever looked at their pit design, it's kind of laughable because it's cut in a straight line at the border. It's not that usual egg shape or round design for their open pit. And the reason it's got a straight line on it is because of the border with Orion. So I just argue that there's going to be some sort of transaction. I don't know what it'll look like. I don't know what it's worth. But I do believe that deposit is not going to move forward until some sort of consolidation happens in the region. And I think my own personal belief is that Orion's share of that adjoining property is worth at least the current market cap, if not substantially more. So I think that's an idea worth looking at as well.
Mm-hmm. So when you're a small cap speculator and you're looking at these potential investments, it's essentially odds making, right? Or coming to your own conclusion regarding probabilities and whether the risk reward ratio lines up. My question is, like anytime I watch a YouTube on sports or watch a sports game, half of the commercials now are sports betting. Do you see any difference between sports betting, which is all about odds making and probability, and what you and I do as small cap speculators?
I mean, there's certainly some similarities. I mean, I hate to kind of ever really admit that what we do is that speculative. While there's similarities, there's actually just real great differences too.
We're putting money in companies that don't make money. So it has to be speculative.
Well, certainly it does. But at what point do you feel that an investment is de-risked to the point where you can identify real asymmetry in outcomes? And I think that's where the difference is and the opportunity is. I mean, even in sports betting, I mean, I don't know, maybe they're more similar than I think, because if you bet on the favorite, you get a smaller payout. Is it the same in mining? I'll have to give that some more thought.
It is, because a lot of the good management teams that had previous success, all their deals have a success premium already built into it. Whereas if you get a guy that may be qualified but doesn't quite have that brand established, their deal, assuming the geology and the opportunity looks good, is going to be priced lower. I've seen that.
Yeah, but don't you think that's where cycles come in? I mean, I agree with what you're saying. I've seen successful mining guys price their new venture where it's like you want to come in, you're already paying $100 million market cap just to play. No, I'm sorry, I don't do that. What I try and do is understand who those people are and perhaps wait for them to not be as highly regarded, or wait for just a cycle to come around where that formerly hot deal is now trading like a, more where it belongs, but it has those people in it. And so waiting for the time when that that premium has been eroded away.
And would you say that was the case with Tenaz and Tony?
I think so. He was an unknown player in the world of oil and gas startups because he'd never done it before. And so I think the edge there, if there was one, was to really spend some time on understanding who this guy was. And again, it wasn't rock. I mean, it's easy looking back, I suppose. But even at the time, I would have had to say it wasn't rocket science to make that bet. And then you could take another bunch of bets like that with some feeling of confidence that one or two of them are going to work out.
And that's what happened in the three you gave. So you had the 9-bagger on Tenaz, you had the 1/6er on grounded lithium, and then on Fortune Bay, it was flat. So you basically, when you group all those together, you got like a 3-bagger, right? Essentially is what it amounted to.
I haven't done the math, but you're probably right. Yeah.
Which is exactly what you explained a year ago on my show, your perspective of why you do it. And one of the ways you mediate the risk factor is by spreading your cash, not concentrating it. You said you let those positions concentrate themselves based on success.
Yes. Yeah. No, I mean, and we did exactly that with Tenaz. So we were still buying it when it was a double, just because it was still had all the markings of a big win. And the only reason we stopped buying it is because of portfolio concentration. So we had to sort of, just sit back and happily wait.
Mm-hmm. Mark, when it comes to screening tools, I know you use screening tools. You've shared some of the tools you use on a past episode. But of the positions that are in your portfolio now, how many came through like a screening tool and how many came through a relationship where, a relationship you had or somebody said, hey, Mark, take a look at this one?
Bill, as you and I both know, we don't talk before these. So I had no idea which direction you were going to go in here. But here's what I would say. That's a phenomenal question. And the reason I say that is because I really think that that's part two of maybe something we could have spent a little more time on earlier. Part two is of how to do research and how to be successful in this game is spending time, making phone calls, going to conferences, building a network, phoning management. You'll be shocked at how many people will take your call. Not everyone, but it's shocking how many people will take a call from somebody they've never met. Just introduce yourself as a shareholder. And so I would highly endorse what your suggestion is here, which is, yes, screening is important. Certainly some ideas have come through it. Certainly following people you don't know and finding, the little weak story amongst their group or the forgotten story has proven valuable, but equally valuable, and I don't know what the ratio is, but also very valuable. Build your network, hang out, go to shows, sit around. I saw you recently at Beaver Creek for a few minutes, right? And, a lot of people came up to me and said, well, how many meetings do you have booked? And it's not really a question I really want to answer because it's not that I'm not, I'll happily go and speak to management, and I do obviously go to some presentations, but I'm really there to network with other investors. And that's where the intelligence comes from, is spending those, hours sitting around with, other guys that do similar things to what you and I do and understanding, how they do it and how their mind works and sharing a couple of ideas back and forth. Invaluable, absolutely invaluable. So if there's a message here, and you hinted at it in your question, I would certainly say that it's very wise for anybody, trying to be successful in junior mining or any other investment strategy to take advantage of the fact that, we have these conferences and, insiders that are, often willing to talk and other investors that are willing to share. So it's a big part of it.
So since we've been talking about Tenaz, my final question is, did that come to you through a relationship or through your own due diligence? How did that successful pick come to you?
It did come from relationships.
Somebody offered you a piece of the financing, perhaps?
A couple of astute investors that I know mentioned to me that Altura Energy was an undervalued oil and gas stock. And so I put it on my screen and I watched it carefully. Altura was the predecessor to Tenaz. So at the very end of its life, Altura, strangely, just before it was changing hands and was going to become Tenaz, somebody I would assume on the institutional side was a big seller. And the stock got hammered. And after watching it for a couple of years, that's where I initially bought. So I've owned it before it was Tenaz.
So you had years of due diligence and observation going into that pick. So that's another thing. When you say you take the long-term view, you take it on the front end and the back end.
I watched it for 2 years without owning a share, much to the chagrin of the gentleman who showed it to me, because the stock just kept getting cheaper.
So you had discipline.
I just waited. I waited till it seemed like it, listen, it could have gone lower. But at that moment in time, I just felt like, I don't think this thing can go lower. So, but to your point, it was through network connections.
Yep.
Initially. Yeah.
Yep. And last question even, so the last question was a lie. It wasn't the last question. Did the low oil price, did that affect you at the time where you said, I'm probably going to get a little uplift on the commodity price? This was 3 years ago, right?
Well, it was two and a quarter years ago.
Okay, so then
right?
Oil already had made the jump off the bottom by that time.
Actually, you know what? I think they did their big financing in December of 2022.
Okay.
Is that right?
Yep.
I think so.
So that's a while after the oil bottom.
I honestly do not remember the price of oil on that given day. It's really tough to be involved in these commodity plays to begin with. And I think if your only argument is that the commodity is cheap, again, good luck. For me, again, it was more about picking the right horse, picking management, the kind of management that could make money in a good or bad market. And ultimately, that's really what you want. So, even through years of very, very bad gold market, there's been plenty of takeovers. There's been discoveries. There's just been an enormous amount of, what would you call it, bifurcation, where there's just those few successful stories have done just perfectly fine. And, another very large group has unfortunately struggled quite a lot. But I think, again, sort of ending where we started, I think, if you follow the right people and you believe you're buying into a management group that can make money in any kind of environment, then you're not quite as concerned about commodity prices.
Again, it goes back to bet on management then, right? Yep.
Yes. Yeah.
Mark, you don't have much of a presence on the internet, and you're happy with that. But do you want any of my listeners to look you up on the internet, or you just want to stay more unknown and untouched in that regard?
Well, maybe we can put a URL in the comment section after, if you like.
Okay. All right, everybody, look in the comment section below, and you'll get the URL that Mark sends me for that. Mark, I really appreciate you coming on the show. You do it for me once a year. I get a lot of requests for you to come back. So thanks for coming on the show. And maybe in about 9 months, I'll reach out to you again for another interview.
Always my pleasure. Thanks, Bill.